So a couple things I want to look at before we go into the main presentation is we're going to look at the Form W-2 and we want to look at the Form 1040 again. Okay, this is a W-2, and this is what it looks like when the IRS publishes it. You may see W-2s in different formats. As long as all the information is the same in the same order, it's considered a valid W-2. We have here on the left, we have background information for the employer and background information for employee, including employee social security number, employer identification number, and on the right side is all the number fields. The main ones we're going to be looking at when we're doing a tax return are box 1, which is wages, tips, and other compensation, and box 2, which is federal income tax withholding. I would say something like 90% of tax returns that have W-2s, these are the only two boxes that are relevant to the tax return. Then we have box 3 which is Social Security wages. This is the amount of wages that are subject to Social Security tax, whereas box 1 is the amount of wages that are subject to income tax. Those will often be the same, but they might be different for a couple of reasons. One reason would be if your Social Security income, if your income goes over something like that, I think it's $180,000, you stop paying Social Security tax. So this will be capped off at about $180,000. But if you make $250,000, the whole $250,000 will show up in box 1, but only the $186,000 will show up in box 2. Box 4 will be Social Security tax withheld, which in almost all cases will be exactly 6.2% of whatever's in box 3. And then box 5 is Medicare wages and tips. And this is the amount of your income that's subject to the Medicare tax, which is about 1.5% of your wages. And a lot of things that would make your income exempt from income tax don't apply to making it exempt from Medicare tax. So generally, Medicare wages and tips is going to be the largest of the 3 boxes, because there's also no upper limit. If you make $250,000, you're going to pay Medicare wages and Medicare tax on the whole $250,000. And then Medicare tax withheld is going to be about 1.45%. In many cases, it's going to be exactly 1.45% of whatever is in box 5. I don't know if we'll get to that, where if your income is over $200,000, there's an additional Medicare tax. The additional Medicare tax would also be in box 6. Box 7 is Social Security tips. So for Social Security purposes, your wages and tips are split up into different boxes. Not sure exactly why that is, but if you work in a restaurant and you make your paychecks come out to $20,000 and your tips for the year come out to $30,000, you'll have $50,000 in wages, tips, and other compensation, $20,000 for wages and $30,000 for tips. And then this Social Security tax will be the total based on the total of boxes 3 and 7. Box 8 will be allocated tips. We'll talk about that a little bit later in this session. Then we'll have dependent care benefits. Your employer may provide child care assistance, and that's generally tax-free up to a certain amount. We have box 11 for non-qualified plans. That's for non-qualified deferred compensation. We hardly ever see anything in there. Boxes 12A through 12D are for different other information that's useful for taxes, such as 401k contributions and things like that. There are actually about 30 to 40 different things that might go in these. So instead of having like 30 or 40 lines on the W-2, they just say, well, put the correct code in there, and the amount. So a D, for example, would be 401k contributions. And I know another one, AA, is for Roth 401k contributions. Box 13, we have 3 check boxes here. One's for statutory employee. We hardly ever see that. That is for people who are technically self-employed or independent contractors under the common law, which is basically how things have always been done. But for purposes of Social Security and Medicare tax, they are considered employees. So the main example of a statutory employee would be a traveling salesman. So they would have their own expenses, their own travel expenses, their own supplies and stuff, but their employer has to pay Social Security and Medicare tax for them. Box 13 for retirement plan, if you're covered by a retirement plan at work, that box will be checked and that will affect your eligibility to deduct things like IRA contributions. And then third-party sick pay, some employers contract an insurance company to pay sick pay for their employees, so that if you're injured, you take a couple weeks off from your job and you're getting sick pay during that period of time, you might get a W-2 from the insurance company, and that box third-party sick pay will be checked.
Would that be short-term disability?
Yeah, short-term disability, and even long-term disability might also have that checked.
Cool. Learn interesting.
Box 14, other, is the employer can put anything they want in there that they think you might find useful. So that would be, we'll often see the amount of taxes that was withheld for Alaska unemployment tax. We'll see that in box 14. But we'll see a lot of other stuff in there, and sometimes we don't even know what it is until we have to ask the employer what that means. So could be just some weird jargon in there and a number, and we don't know what that means. And then box 15 is for state information, which state ID number, how much you earned in that state, how much was withheld for that state, and then even some cities have income tax. So there'll be a local wages and tips, local income tax, and the name of the locality, like New York City. We typically won't see anything in box 15 because we don't have an income tax in Alaska. Although instead of putting unemployment tax in box 14, some employers will put that in box 15 because unemployment tax is kind of like an income tax because it's based on a percentage of your income.
Occasionally we'll get freeze, but
Yeah. Yeah, we do have people who work abroad, or we'll have people who've recently moved to Alaska, or we'll have prior customers who move out of Alaska and still want us to do their taxes, so we have to learn how to do taxes for other states.
How many different states do you have?
Well, let's see. We have a lot of people in Oregon, several people in Hawaii, about a dozen people in California, a couple in New York. So I'd say, let's see, North Dakota, South Dakota, Montana. I'd say probably about 12 different states that I'm passing familiar with.
Arizona.
Which one is the
Seems to be
most,
the popular one that I saw this year.
which
Yeah.
one seems to be the most complicated?
New York.
I thought you were gonna say New York, that doesn't surprise me. So, is it common to get $180,000 to $250,000 income if you're doing taxes on?
No, I think we do have people up in that range, but I'd say the bulk of our taxpayers come between the 0 to 85,000 income range.
Yeah, when you said 182 and a half, I'm like,
I think
I know they exist. It's just like a unicorn for me.
I think we have less than a dozen taxpayers over the $200,000 income.
I've seen last year, I did actually probably more than 10 that was over 150.
Mhm.
So I won't say those are common, but they're there.
Yeah.
Plus of it being overtime, but still.
So that's the W-2. And before I go to the 1040, let's look at the W-4 real quick.
That's I'm helpful out.
Then I get the.
So the W-4, so there's a W-2 and a W-4. The W-4 is what you fill in when you first get a job or if you want to change your withholding at that job. This is the withholding certificate. This tells your employer, gives your employer the information they need to accurately withhold. The whole purpose of withholding is that you're paying your taxes during the year instead of paying them all at once on April 15th or whenever you file your tax return. The U.S. tax system is a pay-as-you-go, pay-as-you-earn system, so you're supposed to be paying your taxes all through the year instead of paying at the end of the year. And in fact, if you don't have enough withholding, there's a penalty called the failure to prepay tax or the estimated payment penalty. You just didn't have enough withholding, so they're going to apply interest and they're going to backdate that interest through the whole previous year. Proportionally. So the interest rate is 8%. If you file your return April 15th and you owe $5,000, you should have had that extra withholding. So they're going to take that $5,000, they're going to apply that 8% interest rate, but it's not going to be the whole 8% because they're not going to say you owe it for a whole year. They're just going to blend it out through the whole previous year. So you're going to end up paying about 4 or 5% on top of what you owe because you didn't have enough withholding. On the other hand, if you have too much withholding, then the IRS says, thank you for letting us hold your money, but they're not going to pay you interest. Yeah. So the target is generally to come as close to zero as possible. If you owe a couple hundred or if you get a couple $100 refund, that's considered just about a perfect result. If you end up with a $15,000 refund, well, that's $15,000 is about $1,250 a month that you could have had in your paycheck instead of having it sitting in a zero interest account at the IRS. So this is the withholding certificate, and how this works is you enter your personal information here, you enter your expected filing status here, which is out of the 5 filing statuses, there's only 3 checkboxes. Single and married filing separately share 1 checkbox. Married filing jointly and qualifying surviving spouse share the next checkbox, and head of household has a 3rd checkbox. So that's going to help your employer determine what your standard deduction is and what your tax rates are. The next section is if you have 2 or more jobs. There's multiple different ways you can handle having multiple jobs. The easiest, and it's usually pretty accurate, is just to check this box here at the end saying you have 2 jobs. If you're married filing joint and your spouse also works, that counts as having 2 jobs. So one mistake we see a lot of people make on their W-4s is if they are married and they plan to file a joint return with their spouse, they forget to check that box and they simply don't have enough withholding because both spouses are working. Okay, and then step 3 is where you can claim dependent credits and other credits. So here's the $2,000 child tax credit for each qualifying child under age 17, plus $500 credit for each other dependent. And then most people don't read this, but it also says you can add any other credits that you expect to be able to claim to this amount. So this number isn't necessarily going to be a multiple of 2,000 or 500. You might say, well, I expect to get $800 in child and penny care credit, so you can add that in as well. Step 4, you can add in other income that you expect to get that is not from work, because all of your employment income is subject to withholding, and so you should have accurate withholding. But other income you might get, such as the permanent fund dividend, it's not going to have any taxes withheld for it. So if you omit your permanent fund dividend from the W-4, you're going to include it when you file your tax return, and you're going to end up owing taxes basically just on the permanent fund. And if you don't want that to happen, you can put whatever you expect the permanent fund dividend to be here in box 4A for your other income. Or if you have other income, like maybe you have a rental property and you expect to make about $2,000 a year profit on your rental, and you just want to pay the taxes on it through your work instead of having to come up with a check every April, you can put that extra $2,000 over here for withholding. And since people don't like changing their withholding every year, I recommend for a permanent fund dividend, put something that's more than you expect the permanent fund to ever be, maybe 2,000, maybe 3,000. I've usually been recommending 3,000 because I don't expect their PFD to go above that ever again. Right. And then deductions, if you expect to be able to reduce your income for any reason, you can put that under deductions. The standard deduction is already built into the withholding system. But if you have any other deductions besides the standard deduction, then those extra deductions will go here.
So when I did mine last year
Mhm.
for other income, I got like 20,000 or something down. So I started with this, wasn't sure. So they've already taken the tax, they're starting to take the taxes. Estimated on at 20,000.
Right. Okay, and then you can always have extra withholding. This is a little bit unusual compared to the rest of the form. All these other numbers on the form are per year, but this extra withholding would be per paycheck. So if you want an extra $1,000 taken out because you want to, push in your tax return, make sure you get a refund, then you have to make sure there's approximately 25 paychecks per year. So make sure you put 40 extra withholding instead of 1,000 extra withholding.
Yeah, I think I did 20,000 APA and then 50 out C. I'm sure that if I did blow up the summer big much money, I would have tax would come down.
So, just because I find this a little bit interesting, I don't know. I'm going to show you how the withholding system works. So let's say you have, let's say you have one job and you're paid every week. So let's say how much would you make in a week?
The next page every week.
Okay, so let's say, okay. So $20 an hour, let's say you work full time, so you make $800. So here's your gross pay. And so what the withholding system does is it says, well, how much is that per year? So it multiplies that by 52 and then goes through all the information on your W-4 and basically does a little tax return. So if you, let's say you put single, so you would have a standard deduction. Well, let's say you put additional income of 20,000, like Dan said. So then your adjusted gross income or total income would be the total of these two. And then we'd apply your standard deduction, which we're going to say you mark the box for single, head of household, married, filing jointly, single. So standard deduction for single is $13,850. So your taxable income would be the difference. And then we'd look that up in the tax table. See, in the tax table, now that you just got the books, the tax table is at the front of book 3. The book 3 in your is just a bunch of empty tax forms for you to be able to do the homework. So if your taxable income single is $47,750.
5,800.
5,802?
18.
5,818?
Yes.
Okay, so this is your income tax. And then credits would be, so this additional income here, this is from this is from step 4A of your W4. And then we would have we could have other from step 4B of your W4, but let's say we didn't put anything there. And let's say we marked single, but we put maybe one dependent. So this is from step 3. Maybe we put 2,000 there. Okay, and then we would figure that's your total tax for the whole year. And so we divide that by 52. And round that to the nearest, usually to the nearest dollar. So they'd withhold $73 from your paycheck. And let's say you worked overtime next week, so instead of 800, you made 1,200. It would basically go through this whole thing again. Oh, we'd have to figure the new tax on 68,550. Actually, instead of 1,200, let's say you made twice as much. Let's say you worked a lot of overtime. So you made 1,600 when normally you make 800. So your taxable income is 89,350. Okay, and so on your bigger paycheck, you would have 249 withholding.
For 14,000 or 89,350.
Yeah.
Yep, that's what that's what I got.
I was just excited about that. Okay, but then if you go down to the next one, it says 89,350 to 89,400, and it's 14,970. So which one of those?
Oh, so you would pick the second one. So when it's right on the edge, you'd pick the second one down.
So
it actually
14,970.
okay, which is the same when you divide by 52 and round to the nearest dollar. So on this payday where you got twice as much income, it was more than twice as much withholding. So that basically each paycheck stands on its own, and the withholding system says, well, this paycheck, it assumes that this one paycheck you're getting is representative of all the paychecks you get through the whole year, which is not a great assumption, but it does end up, if your pay fluctuates throughout the year, you have low paychecks and larger paychecks, it ends up over withholding by a little bit, and it hardly ever under withholds. So you'll get the extra back at the end of the year. If you had additional withholding, that would add to the per week. So if you said I want 30 extra withheld per week, then it would be the total of these two. Okay. What happens if you check the 2 jobs box? Then it would do this. It would either multiply, if you had the 2 jobs box, then it would double that, because it would basically assume that your spouse is making the same amount of income that you are. But then it would, and then your income tax on 192,550 would be The table only goes up to 100,000, so we'll go up to. So we're still going single, right? So we would go this times 0.32 minus 21,168. Okay. But then because of the two jobs box, this would be your tax on both your jobs. So it's going to end up dividing that by 2 for the two jobs box. So filling out your W-4 correctly means that you should get pretty close to a zero refund, little or maybe a small refund or a small amount owed at the end of the year, if you filled it in correctly, and assuming that all of your pay is earned evenly throughout the year. So if you, let's say you are head of household with 2 dependents, both under 17, and you're only working one job, you would check this box for head of household. You would put 4,000 here for your kids, put a couple $1,000 here for the permanent fund dividends, and then you'll end up getting close to no refund. And having a big refund is actually a bad thing because that means you could have had that in your paycheck instead of putting in the 0% savings account. I especially recommend having close to zero refund for people who borrow a lot of money on their credit cards, because if you're borrowing at 17%, but your paychecks could have been $200 larger every week, then you wouldn't have had to borrow quite so much on your credit cards.